You woke up this morning and checked your bank account. Maybe you looked at mortgage rates in the middle of the night, saw the word inflation again, felt that familiar knot form in your stomach, and kept moving. The global financial system relies on this collective momentum. It functions best when the public ignores macroeconomic shifts and simply focuses on the next paycheck. The perceived distance between your savings account and institutional Wall Street is a fabricated distance. It serves as a psychological buffer, keeping the complexity of the system out of sight. The legal and structural shifts following the 2008 crisis prioritized the stability of large-scale institutions over the protection of individual wealth. This restructuring created a machinery designed for wealth extraction rather than security. A single private corporation now sits at the center of this new economic order, wielding influence that exceeds the reach of most central banks. Its name is BlackRock. It currently manages $14.1 trillion in assets. This scale includes an additional $21.6 trillion monitored by its AI, exceeding the economic output of nearly every nation on Earth. Zooming out to this distribution web, BlackRock is the largest shareholder in 90. Because Aladdin manages such a vast percentage of global wealth, its predictions trigger automated mass sell-offs. The sheer volume of these exits creates the very market volatility the system was trying to avoid. Aladdin has transitioned from a tool that observes the market to a force that dictates it. The global economy is now caught in a cycle of algorithmic, self-fulfilling prophecies. This high-level architecture is creating immediate pressure on the ground. Inflation currently sits at 4.2%, while economic growth has slowed to less than 1%. Economists call this stagflation. The last time the Western world faced this specific environment was the 1970s, leading to a decade of severe economic contraction. Unlike the 1970s, today's market is highly centralized. A single algorithmic entity now holds controlling stakes across the entire supply chain. This centralization has reached the residential housing market, where institutional investors are now purchasing 25% of all new-build homes in America and Britain. These institutional buyers target new developments to convert them into permanent rental portfolios, siphoning potential equity from the middle class into corporate balance sheets. The combination of soaring home prices and elevated interest rates creates a barrier to entry that locks an entire generation into a rent-based economy. This housing crisis is a feature of a system designed to trap working-class wealth. In March of 2026, a structural failure appeared in this design. It was revealed in a quiet financial report, filed away while the public focused on larger headlines. BlackRock suddenly froze withdrawals from its HPS credit fund, an asset pool valued at $26 billion. Investors, concerned about the broader stagflationary environment, requested to pull out $1.2 billion in cash. The fund returned $51 million, exactly 5%. When a credit fund of this size, managed by the world's most sophisticated risk algorithm, loses the ability to return its investors' cash, it signals a fundamental drying up of global credit. This freeze shows that even with Aladdin's predictions, the system is struggling to navigate the reality of 2026. The gears of the liquidity trap are already beginning to lock.
Financial journalists often use terms like liquidity management and redemption gates. It is specialized language that can make a serious event sound administrative. But in plain terms, what they are describing is a fund freeze, the moment an institution decides not to return your capital. In March 2026, a group of institutional investors, including pension funds and sovereign wealth funds, requested $1.2 billion back from BlackRock's HPS credit advisors. This is a massive vehicle built on private credit and corporate loans. Despite the billion-dollar request, BlackRock returned just $62 million. This chart shows the scale of that discrepancy. If you had $100 in that fund and asked for a full withdrawal, you were handed $5 and told to wait. The official justification is that private credit funds hold illiquid assets. These are private loans that cannot be liquidated on an open exchange overnight. Because of this, the industry considers these gates a standard part of the risk profile. This is the most significant takeaway from the event.
The legal framework of modern alternative investments is designed so that the managers reserve the right to stop withdrawals whenever they deem it necessary for the fund's stability. In the private credit market, the concept of liquidity is a variable determined by the manager. Standard practice means in this asset class, your access to capital is a feature that can be restricted the moment the market grows volatile. The freeze at HPS was not an isolated incident. It happened because three distinct macroeconomic forces converged on the market simultaneously, with BlackRock positioned at the center of all three. Force 1 is the private credit market, grown to a $1.7 trillion scale. Without public exchanges, transparent pricing vanishes. Values are determined by the firm's internal models. Force 2 is April 2026's stagflation, defined by 4.2% inflation paired with sub-1% growth. This creates a mechanical trap. The standard method for lowering inflation is to raise interest rates, but doing so during low growth risks pushing the economy into a deep recession. Conversely, if the central bank tries to stimulate growth by lowering rates or injecting capital, they risk making the inflation problem even worse. The two problems effectively paralyze traditional policy. Caught between stagflation and the illiquidity of the private credit market, the structural limitations of the current financial system become much easier to see. Force 3 involves the physical world. Large institutional investors are now using algorithmic systems to concentrate their capital into residential real estate. In the United States and the United Kingdom, these institutions are now the buyers of 25% of all new residential homes hitting the market. The objective is not to resell these homes for a quick profit. Instead, these entities look to control supply and establish a permanent stream of rental income. This image of UK apartments highlights the strategy's geographic reach. From American suburbs to British city centers, the logic remains, consolidating ownership across multiple markets. This ownership concentration changes the market structure. It makes homeownership increasingly difficult, effectively removing the primary way most families build long-term wealth. For a generation that expected to transition from renting to owning, the market has shifted. Renting is being transformed from a temporary stage into a long-term requirement for many. Think about how these nodes connect. What are the implications when the same company managing your pension also owns the debt of your employer and the home where you pay rent? This chart shows how those connections form a closed loop. Rent payments, retirement contributions, and corporate debt all flow into the same institutional ecosystem, creating a high degree of capital concentration. At the center of this integrated system is a piece of infrastructure that monitors every asset class on the planet. It is an algorithmic platform known as Aladdin. Aladdin processes 40 million calculations every day. It runs the risk models and data projections that not only private firms use, but that national governments and central banks rely on to understand global markets. While it is often described as a tool for managing risk, it also provides the data necessary to coordinate massive operations. It allows a single firm to monitor a neighborhood's housing inventory, manage $56 billion in Bitcoin, and time the freezing of a private credit fund. Regulators at the Federal Reserve observe these movements, but they are often using the same data and models that the institutions themselves are providing. This concentration of financial leverage creates a significant barrier between individuals and the markets they rely on. By the time the scale of this influence is fully understood, the system has already become an essential part of the global infrastructure. In 1999, a small team of risk analysts built a software system to do one highly specific task: analyze bond risk. They called it Aladdin. It was a simple tool, a calculator, a sophisticated spreadsheet for people managing mortgage-backed securities. 27 years later, that exact software tool monitors $21.6 trillion in global assets. This diagram shows the scale of that number in human terms. The entire GDP of the United States for a full year, every car manufactured, every house built, every meal served, and every software license sold is approximately $29 trillion. Aladdin watches 75% of that volume every single day. It functions as the largest financial nervous system on the planet, tracking global capital as it moves in real time. The public assumes Wall Street relies on thousands of competing systems. The reality is that one calculator quietly matured into the active infrastructure of the most productive economy in human history. Most people, when they hear an AI monitors assets, picture a surveillance camera, a passive system that watches and reports. Aladdin doesn't watch, Aladdin decides. It actively runs the risk models. It dictates portfolios for pension funds in Norway, sovereign wealth funds in the Gulf, and the central bank reserves across Europe. And since 2020, quietly but officially, it manages crisis intervention programs for several arms of the United States Federal Reserve. The central bank of the US government relies on BlackRock's proprietary AI. That means the public authority led by Jerome Powell directly utilizes outsourced algorithmic decisions to manage national economic stability. The boundary between private financial machinery and public global governance has effectively been erased. Diversification requires competing strategies to create equilibrium. When one panics, another buys. But massive insurance giants and rival funds secretly license Aladdin, assessing danger using the exact same algorithm. When 40,000 professionals rely on one brain, trusting identical signals, they make the exact same decisions simultaneously. Because the fundamental core requirement of market disagreement is now entirely gone, the concept of diversification is completely dead. In complexity theory, this synchronized collapse is called monoculture risk. BlackRock's own academic researchers identified the vulnerability and coined the term. They wrote the papers detailing the threat, and then they continued to aggressively license the specific software that causes it to their competitors. The operating system designed to protect individual portfolios from ruin is now mathematically the single greatest source of systemic global collapse. In 2026, BlackRock began migrating Aladdin toward what they call agentic AI. These are systems that identify opportunities, execute strategies, and manage positions entirely without a human professional in the decision loop. We are watching machines trade automatically, at scale, across a quarter of the world's investable wealth. Sitting right alongside this move to autonomous trading is a $56 billion position in a Bitcoin ETF. It is the largest single institutional holding of the asset on the planet. Bitcoin was explicitly engineered as a decentralized ledger to operate entirely outside of traditional architecture and replace Wall Street. But the perimeter has moved. BlackRock owns the traditional markets. They own alternative private equity markets. Now they own the crypto ledgers, and their singular risk model manages the exposure across all of it. There is no asset class left outside the perimeter. The capture is complete. We know the machine's scale. We know the architecture. But we haven't answered the most important question. When a private, autonomous system this powerful eventually fails, who actually stands to benefit?
Regulatory capture happens quietly, unfolding as a slow, legal process of decay. The system simply rusts from within. The entities meant to be monitored grow so massive, and their internal plumbing so technically complex, that government agencies lose the basic capacity to function without them. The regulated becomes the indispensable. BlackRock represents the apex of this evolution. We are long past the era of a bank being merely too big to fail. In 2026, BlackRock is too deeply embedded in the underlying architecture to regulate. The global economy now faces a player that has functionally consumed the referee. Look at exactly what happened when the pandemic halted global trade in 2020. That sudden panic gave cover for highly unusual emergency measures. To manage its crisis response, the United States Federal Reserve effectively outsourced its emergency bond buying program to a private company, utilizing BlackRock's proprietary Aladdin system to direct the capital. The government was using public money to buy financial assets, guided by the precise firm whose own funds were being purchased. BlackRock acted as both the official advisor and the immediate beneficiary. If this were a courtroom, the judge's bench would be empty, and the defense attorney and the prosecutor would be the same man, negotiating a verdict with himself. For decades, Western economies structured their tax codes and cultural mythologies around one core idea. Owning the place where you sleep is the reliable mechanism for building intergenerational wealth. That mechanism is being dismantled. Institutional capital is using algorithmic analysis to identify specific high-yield neighborhoods, purchasing massive percentages of new residential construction, and permanently removing that supply from ordinary buyers.
This diagram outlines the extraction cycle. Wages pour into retail pensions, Node A, feeding institutional funds at Node B. These funds move to Node C, buying the housing supply. Your capital outbids you for a home, forcing you to rent the exact property your savings financed. The current housing crisis is a system engineered to convert middle-class equity into a permanent rental subscription model for corporate yield. The danger goes deeper than real estate. Over the last decade, as near-zero interest rates starved investors of steady returns, money flooded into an asset class called private credit, swelling it into a $1.7 trillion shadow system. Financial complexity serves one consistent function throughout history. It obscures systemic risk until the damage is already done. When corporate borrowers begin defaulting under the pressure of stagflation, the entities trapped at the bottom won't be billionaire hedge funds. The losses will hit the institutional custodians managing the retirement savings of teachers, nurses, and civil servants. And when these funds freeze withdrawals, as we saw with the recent HPS credit suspension, they are operating within the law. Trapping your capital and paying out a fraction of its value is explicitly detailed in the prospectus. We have to confront a terrifying reality. Can a financial machine operate flawlessly according to its own internal legal logic, while simultaneously devouring the human civilization it operates inside? The architects of this economy are already migrating their capital out of the rubble and into Bitcoin and agentic AI. This maneuver ensures survival. When an over-leveraged system eventually fractures, the institution that has already secured the perimeter of the replacement economy does not lose its standing. It wins twice. In 2017, CEO Larry Fink called Bitcoin an index of money laundering. Today, his firm is its largest institutional holder on the planet. Securing $56 billion in Bitcoin is not a temporary speculative trade. It is a permanent reservation at the head table of whatever financial architecture rises from the ashes of this one, which leaves us with the only question that matters. What do you do when the regulatory apparatus and financial markets are captured by trillion-dollar institutions? The traditional escape routes no longer function. Your stocks and your bonds, your residential real estate, and even decentralized crypto networks, they are all fully enclosed within BlackRock's perimeter. The answers in Chapter 5 offer no comfort or reassurance, only the brutal honesty required for a survival strategy. As we approach the 2026 reckoning, comfortable illusions are a liability. Facing the precise mechanical truth about the death of the old system is the single most valuable asset you have left.
Let's step back from the high-level analysis for a moment. We need to look at what 2026 looks like at your kitchen table, the place where the actual decisions that dictate your life happen. The modern financial architecture operates efficiently only when retail investors believe they have no agency. The system requires your passivity to maintain momentum. In 2026, inaction is a choice with real consequences. By leaving your money in the default vehicles you were sold, you are placing an active bet that a highly fragile structure will hold up under extreme pressure. This chart shows the incoming private credit maturity wall. Notice the massive spike clustering around 2026 and 2027. Approximately $300 billion in corporate loans are scheduled for forced refinancing over the next 24 months. Look at this red line. These corporate loans were issued when interest rates sat near zero. They are now hitting a wall of elevated rates and stalling economic growth. Mathematically, a large portion of these loans will not refinance cleanly. When these underlying companies default, the institutional funds holding that debt will face immediate withdrawal requests. To prevent a total collapse, those funds will lower the gates, freezing your capital inside to protect their own liquidity. You need to call your pension administrator today. Ask for your fund's specific allocation to private credit and illiquid alternatives. Find out exactly what percentage of your portfolio could be frozen in a stress scenario. Systemic failures capitalize on the space between a broad marketing brochure and the specific legal fine print. Precise knowledge of your fund's redemption terms is your only defense. Institutional capital relies on rigid algorithms to acquire residential real estate. These models target specific property types and geographic clusters, like these identical suburban rows, that offer a predictable yield profile.
This heat map shows institutional target zones in red. Algorithms move in predictable patterns, leaving behind massive gray zones. Inside these zones are secondary markets and non-standard lots. A $26 billion fund cannot scale these because they don't fit a standardized spreadsheet. Evaluating these properties requires local context, patience, and human judgment. These are variables an algorithm cannot process. A fund manager in a skyscraper cannot walk a neighborhood to weigh its specific resilience. Operating outside the institutional perimeter provides a structural advantage. In 2026, the gaps left by the algorithms are where the most resilient opportunities are found. Because so much of the global financial system runs on BlackRock's Aladdin, thousands of institutions use the exact same risk models. This creates a feedback loop where everyone decides to sell at the same time. Look at this dashboard tracking the 2020 crash. When a panic signal hits the network, asset prices drop faster and deeper than the underlying economic reality supports. This creates a brief window of irrational pricing. Historically, these windows of dislocation are the most significant wealth-building moments. They offer the chance to acquire high-quality assets at prices driven purely by algorithmic panic. Generating immense wealth in this environment requires simply moving against the correlated momentum of the Aladdin network. BlackRock's massive IBIT ETF absorbs Bitcoin into the traditional banking perimeter. It replaces decentralized ownership with a paper claim, turning the asset into a component of the same system it was built to bypass. When you hold Bitcoin through an ETF, it becomes subject to the same institutional risk models and correlated liquidation pressures we've discussed. It is no longer outside the fence. Direct self-custody requires the technical effort of securing your own hardware, but it is the only way to maintain the structural independence the protocol originally provided. You must choose your objective. You are either buying price exposure to a centralized chart, or you are choosing to own a decentralized asset. Here is your survival framework. First, identify the exact asset class of every financial product you own. Second, if you are being offered above-market returns, realize you are likely being paid to accept illiquidity risk. Decide if the price is right. Third, prioritize accessible, ungated capital. In a stagflationary environment where institutional stress is building, genuine liquidity is not an opportunity cost. It is your most important insurance policy. Fourth, deploy your capital at a human scale where algorithms cannot compete. Finally, study institutional capital flows so you can position yourself ahead of the movement rather than getting trapped beneath it. Navigating this incoming reckoning requires replacing the comfort of passive compliance with the friction of agile, informed action. This architecture was not built out of malice. It is the result of legal optimization by a system designed purely to extract returns. But we have to face the outcome. At what point does a private wealth engine become so embedded in global infrastructure that it functions as an unchecked public utility? If a single firm has effectively captured the structural mechanics of our markets, our pensions, and our homes, who authorized that? And why was the public absent from the room? This architecture depends on your continued passivity. Choosing to investigate your own exposure and moving your capital toward human-scale opportunities breaks the momentum of a system that thrives on your inaction. Subscribe, think, act.